friends, hello viewers, you're most welcome. Thank you for tuning in once again. Now, this is none other than your host, Mr. Spotter Fred. We want to continue with our development of this long topic known as consolidation. Remember, we had introduced consolidation in several lessons or sessions before. We talked about consolidation as business combination or as group accounts. Now, we have developed this topic so frequently. Remember, we were talking about consolidating a balance sheet, or rather preparing a group statement of financial position. We looked at a scenario whereby we have acquired 100% and the date of acquisition is the same date of consolidation. Remember, we also looked at a second example where the acquisition was at 100%, but the date of acquisition was not the same date as consolidation. That's where the pre-acquisition retained earnings and the post-acquisition retained earnings came in. Then we looked at that example where the acquisition is less than 100% and the date of acquisition is not the same date of consolidation. That's where now we brought in the element of non-controlling interest. Then that's how we realize what a non-controlling interest is and the effect to the group accounts. We looked at the example number 4, where we looked at the purchase consideration, where the purchase consideration has not been accounted for in the books. In addition to that, where the purchase consideration is not only paid by cash, but also paid by share exchange. We looked at that and we did a good example on the same. Then we looked at another example, number 5, in another session. Now, in that case, we looked at other adjustments, other balance sheet adjustment. In this example, this was example number 5. We looked at other adjustment. For example, number 1, we looked at the preference share capital in the subsidiary. What if we acquire the preference share capital in the subsidiary? The second item we looked at in that example number 5 was the redeemable preference share capital, or the debentures, or the loan stock. What do you do if you acquire debentures, loan stock in the subsidiary? Then we looked at another example, number 6, in the other session. We looked at example number 6. Friends, in example number 6, we were looking at other balance sheet adjustment number 3, like intercompany owings. We also looked at, apart from intercompany owings, before intercompany owings, we looked at the bonus issue. Then we looked at intercompany owing in a separate example, number 7. We looked at unrealized profits on closing stock. We also looked at items in transit. That is where we talked about the downstream transaction of unrealized profits and the upstream transaction. That's with respect to example number 7. Friends, we moved on and we looked at example number 8. Example number 8 was simply the same, talk about the intercompany owings, items in transit, and the unrealized profits on closing stock. Now, in this session, we are moving on. We are still talking about group accounts. We have we are discussing about accounting for a subsidiary. That is in respect to IFRS 10, 3, and IAS 27. Not forgetting preparation of a group statement of financial position. So we are looking at other adjustments, other balance sheet, so far we have looked at the preference shares in the subsidiary. We have looked at that in the previous sessions. Number 2, we have looked at the debentures or the loan stock or the redeemable preference shares in the subsidiary. we have looked at the bonus shares in the subsidiary, or the bonus shares issued by subsidiary. We have looked at even an example for that. Number 4, we have looked at intercompany owing or intercompany debts, and we have looked at an example. And we have also looked at the items in transit. We have also looked at the unrealized profits on closing stock. Then now, number 7, friends, we want to look at fair value adjustment. In respect to the property, plant, equipment, we also have the intercompany sale of PPE. Those are the 2 items we want to discuss in this session. Don't forget, in other sessions, subsequent sessions, we'll be looking at intercompany. We have intercompany dividends. We also have the goodwill. We are going to talk about goodwill. Remember, in respect to IFRS number 3, how do we account for goodwill? So those are some of the items we'll be looking at. But for today's session, we are going to look at the 2 items, the fair value adjustment, intercompany sale of PP, and we do an illustration. Okay, fine. So we are going to do look at the 2 items and look at an illustration accordingly. So as we have said, we are talking about adjustment number 8, the fair value adjustment. Now, friends, when we talk of the fair value adjustment, is simply the revaluation. What happens sometimes, a company may be acquired. At the date of acquisition, they may revalue their assets. If they revalue their assets, they may opt to either incorporate the revaluation in their books or not to incorporate revaluation in their books. So this is simply revaluation. Now, on acquisition, assets may be revalued upwards, and the company, the subsidiary, may either A, incorporate revaluation in the books, or B, not to incorporate revaluation. If the company will incorporate revaluation in their books, then you will always have a revaluation reserve in the balance sheet of the subsidiary. If there is a revaluation that was incorporated in the books, I repeat on that, you will always find a revaluation reserve in the subsidiary. If there is a revaluation reserve in the subsidiary, then that revaluation will be treated as a pre-acquisition item. That's a very rare scenario, friends. If there is a revaluation reserve in the books of the subsidiary, then it means that the revaluation was incorporated. If you look at the balance sheet of the subsidiary, you realize that there is a revaluation reserve. Then revaluation was incorporated, and your business is so easy just to treat it as a pre-acquisition item. The group share of the revaluation will be credited to the cost of control, while the NCI share of the revaluation will be credited to non-controlling interest. And that's all, nothing else to do. So in this case, we say A, where revaluation was incorporated. Where revaluation was incorporated, life is very simple. You simply debit the revaluation reserve, then you credit the cost of control with the group share. You also credit the NCI with the NCI share. That's what you do. You recognize it as a pre-acquisition item, and the group share will be credited to the cost of control, while the NCI share will be credited to non-controlling interest account, and that will be all, nothing else. But in a case where revaluation was never incorporated, where revaluation was never incorporated. Now, friends, one thing you need to know, once we have revalued an asset, there are always 2 or 3 things you need to remember. An asset will be increased by the revaluation. Once you have increased the asset by the revaluation, you always depreciate that asset using the revalued amount. So if the asset was revalued but the revaluation was never incorporated in the books, then that means that depreciation was calculated based on the original cost instead of the revalued amount. Secondly, that means if you must have depreciated using the original cost, then you underprovided for depreciation. If you underprovide for depreciation, you overstate the assets, you also overstate the profits. So you must do the necessary adjustment to that effect. Apart from that, apart from the depreciation, or rather the revaluation the depreciation adjustment, you also need to do the revaluation adjustment as we have done it. You do the revaluation, you recognize it in the first place, meaning you increase the asset, then you recognize that revaluation as a pre-acquisition item. So there are 2 main things that you need to remember. If revaluation was never incorporated, which is very, very common, friends, then you must increase the asset to their revaluation. That revaluation reserve will be treated as a pre-acquisition item. Then there will be a depreciation adjustment. So Roman 1, you must carry out the revaluation adjustment. First, create the revaluation and adjust the PP, whereby you are going to debit the PP, our group PP account, then we are going to credit the revaluation reserve, because that item was not recognized in the first place. Secondly, after you have recognized, revaluation reserve will be treated as a pre-acquisition, item. Thus, we are going to debit the revaluation reserve we credit our cost of control with the group share, then you credit non-controlling interest account with NCI share. That's exactly what you do. That's a revaluation adjustment. Then, friends, you also need to carry out a depreciation adjustment. Especially if it's a depreciable asset. You know, we don't depreciate land. So in case is land involved in the process, then there's no depreciation adjustment. But if it's a depreciable asset, then we must carry out the depreciation adjustment. The depreciation adjustment, definitely the depreciation undercharge. What we do, so determine the total depreciation undercharged from the date of acquisition to the date of consolidation. Remember, the date of acquisition is the date when we acquired the subsidiary to the date of consolidation. Very important there. So how do you go about it? You simply get either you take the depreciation rate, you multiply the revaluation surplus, you multiply the number of years, or you take the revaluation surplus, you divide by the estimated remaining useful life in years, then you multiply number of years. Now the number of years we are talking about here is from the date of acquisition to the date of consolidation. The date of acquisition up to the date of consolidation, it can be months. Not necessarily the number of years, it can be months, it can be years. So that's what you do. You get the total cumulative depreciation. Thus, you are going to debit our group retained earnings with the group share of depreciation and a charge. Then you are going to debit the NCI account with the NCI share of depreciation and a charge. Then we are going to credit our group PPE or property, plant and equipment with the total depreciation and a charge. That's exactly what we do. So that's the most important thing. We are going to debit, don't forget that, we are going to debit our group retained earnings with the group share of the depreciation and a charge. We debit our NCI with the NCI share of the depreciation and a charge. We credit our group PP, because if you underprovide for depreciation, you overstate the value of the assets, you also overstate the profit. So you need to do that adjustments accordingly. That is in respect to depreciation adjustment. We have talked about fair value adjustments. Now our next agenda is to look at intercompany sale of property, plant and equipment. We want to look at intercompany sale of property, plant and equipment before we look at an illustration. So we come and say intercompany sale. This is where one group member will sell an asset to another group member. So we say where a group member sells an asset to another group member. Either the holding company selling to the subsidiary or the subsidiary selling to the holding company. They either sell at a profit or they sell at a loss. Now when that happens, you know, if a group member sells an asset to another group member at a profit, then you should remember, because for the purpose of consolidation, there was no profit that should be recognized. That is unrealized, because just within the group, we need to determine the profit and reverse it. The same story with the loss. If it was a loss, we need to determine that and do a reversal. If one asset was sold to another group member at a profit or loss, meaning the selling price was higher than the cost, or the selling price was lower than the cost, meaning making a loss, then there must have been either a depreciation and a charge or a depreciation of a charge, and that need to be corrected. So what we do is this. We say there are two adjustments. There are two adjustments here. A, we have the unrealized profits or unrealized losses adjustment. Listen to me carefully there, friends. I'm saying unrealized profits or unrealized losses adjustment is either a profit, it was sold at a profit, or it was sold at a loss. Even in this case, when we talk of unrealized profits, we may have two scenarios. If we talk of unrealized profit, there are two scenarios. Either it was a downstream transaction or upstream transaction. So we come and say, Roman 1, for downstream transaction, if it's a downstream transaction, it means that the holding company sold the asset to the subsidiary. So if it's a downstream transaction, the unrealized profit must be determined and eliminated this way. We simply debit group retained earnings then we credit our group PPE. This is with the total. So you must debit your group retained earnings, you credit your group PPE with the total unrealized profits in case of a downstream transaction. Now, you also need to remember, for upstream transaction, I need to remind you every time. I still remind you this, friends. I still remind you, upstream transaction is where the subsidiary sold goods to the holding company. If that is the case, then unrealized profit will have to be determined and eliminated this way. We debit our group retained earnings, so group share. We also debit NCI account, NCI share of the unrealized profits. Then you credit a group PP account with the total. This is with the total. So that's exactly what you need to remember when it comes to unrealized profits. When it comes to unrealized profits. Now, when it comes to unrealized losses, friends, definitely is the opposite. If it's unrealized losses, now you need to remember that you do it for the opposite. Then from there, apart from unrealized profits or unrealized losses, we have depreciation under or depreciation overcharge. Depreciation under or overcharge. So I'll come and say we have depreciation under or depreciation overcharge. So we talk about B, depreciation over or undercharge. Depreciation will either be overcharged if the asset was sold at a selling price which was higher than which was higher than the cost price. That is an overcharge, meaning they made a profit on sale. It will be an undercharge if it was sold at a loss. Let me be consistent here. Let me talk about depreciation, undercharge. So the total depreciation undercharge must be determined, whereby you determine it by taking the depreciation rate, you multiply by the unrealized profits, then you multiply by the number of years from date the asset was bought to the date of consolidation. Number of years from date of asset was bought to the date of consolidation. To the date of consolidation. That's exactly the position. Or alternatively, you may have, if you're not given the depreciation rate, you may simply get the unrealized profits. You divide unrealized profits in the sale of that asset. You divide it by the number of years, number of useful life in years. Then you multiply number of years from purchase date to consolidation. And you get the total depreciation undercharge. Now, if it's a depreciation overcharge, we are going to do the same. If it's a depreciation, and charge. This is the depreciation overcharge. If it's a depreciation overcharge, we are using unrealized profits. If it's a depreciation undercharge, we'll be using unrealized losses. That's very important to know. Now, in that case, after we have done that, thus